Hello, welcome to another of my Facebook Lives. I guess there's, let me see if I can share to a group. Let's check it in there, and I've got a couple of groups, I'll chuck it in. Oops, closing it down here. Okay, oh, of course I've got to figure out how to get out of here now. Right, good. I didn't see anybody pop up, so let's cancel. All right. Hey, Martin Whittard, how you doing? Good. I've got a bunch of people popping up now, so I'd like to give people a few minutes to pop on. So some of you know I just came back from Lake Como, and yeah, thanks for your message there, Martin. That was awesome. I know you were just down the road, so maybe next time we'll catch up. So yeah, went to Lake Como, had an awesome time with Isabel, and we got engaged. So we had a beautiful hotel on the edge of the lake, which was just gorgeous. And again, if you want to look at my Facebook, you'll see it was a beautiful, beautiful place overlooking the lake. And so yeah, I'm not typically the romantic type, but I think I, as I say, knocked it out of the park this time. So yeah, really did pretty well. So even if I do say so myself, she seemed pretty happy anyway. I don't know if it was the ring or the 11-course meal that we gave before, or what, but certainly went down really, really well. So okay, so just a bit of housekeeping. If you are watching on replay, if you could just comment in there, hashtag replay. If you are brand new, it's the first time you're watching one of my Facebook Lives, hashtag new. And of course, feel free to comment, post in the group, ask questions, put lots of likes, love hearts, loads and loads of love hearts. And by all means, share or tag anybody right now that you feel maybe get some value out of coming on to listen to today. So today, hey Blessing, hey, good to see you. And so today I'm gonna, I'm gonna talk about some financial education stuff. And again, the last 4 or so Facebook Lives I've done have been kind of personal development mindset stuff, like why people fail and why do you not have to fail, how to basically create more time. So again, that one went down pretty well. So if you haven't seen those, you can either kind of scroll back and see my previous ones, or if you just go to my YouTube, just YouTube, my name, Steve Owbridge, in there, and I'm sure you'll find my channel. What I've been doing is, after a week or so, I've been uploading these Facebook Lives to like a playlist in my YouTube channel. So again, if you want to access them there, you can do that as well. Now, hopefully this week, I'm still kind of new to Facebook Live and all the gadgets and stuff. So hopefully the writing is going to be the right way round on the board. Everyone's going to hear me. I won't cut anybody off, and the quality will be great. So today we're going to talk about how to basically how mortgages work in a way, but also how you can literally pay your mortgage off quicker, understand about how mortgages are set up to work against you, and how you can overcome that. Okay, so the first thing to understand, in fact, let me see, if you've got a mortgage, then again, give me a thumbs up, a love hearts, or whatever it is. So the first thing is, if you have a mortgage, then the first thing to understand is, what is a mortgage? Okay, so mortgage is, when you get a loan, a very big loan to buy a property, buy a house. Hey Helen, thanks for jumping on. So mortgage, but first of all, there's a bit of a clue here, okay? The word mort means death, okay? So mort, like mortuary, right? And then the word gauge means pledge, okay? So the word mortgage actually means death pledge. I know that's not a really great marketing name, okay? That's why they don't call it that, because if someone says, hey, can I get a death pledge to buy a house? it's not very doesn't sound good, does it? So basically, can I get a big loan that keeps me in debt for the rest of my life? Okay, so understand that it's called a death pledge, and it's called a death pledge for a reason. You see, the system is designed to get you into and keep you in debt. Okay, it's designed that way. It's not an accident. It's not magic. It's by design. Okay. Again, we can go into all sorts of reasons why that is the case. From the borrower being the servant to the lender, to being a wage slave, the debt slave, etc. When you get into debt, I always say that debt is a weapon of mass destruction. And what I mean by that is it destroys families, it destroys relationships. Hey, Mimi from Mauritius. It's not a good thing in that respect, okay? Debt is a weapon of mass destruction, but also it's a weapon of mass distraction. So what that means is it can keep you from your goals. It can keep you from achieving the things that you want to achieve. So if you're worried about paying the mortgage, or worried about paying the credit card, then you're concerned about that thing, which kind of means you're not focused on the things that you need to do to get your goals. You're not focused on those next steps. You're not focused on those daily activity, the daily disciplines, whatever it happens to be. So the system's designed to get you and keep you in debt. Now, I'll give you an example of this. So we're taught to ask all the wrong questions. Okay, so whenever we go for a loan or a mortgage, something like that, we ask questions like, what is the APR, right? And we say, what's the APR and what's the monthly payment? What's the APR and what's the monthly payment? First of all, how many of us really know how to work out an APR? Maybe some people know what that stands for, but how do you work it out? It's complex, okay? APR, it means April, basically. But it means annual percentage rate. But the fact is you don't know how to work it out. And APRs change depending on length of loans, structure of loans, whether there's an arrangement fee included or not, whether there's a deferred payment, whether there's a balloon payment, on all these things, that changes APRs. And so it's not, that great a comparison. So who told us to compare interest rates? Well, here's a clue. Is it the people with interest rates all over their windows? So next time you're out shopping, you see big interest rates everywhere. The people that want to lend money tell us to compare interest rates. But actually the right questions to ask, the right comparisons are what is the amount of pounds that it's going to cost me? So when I borrow this amount of money, how many pounds will I be paying extra to borrow this money? What's the pounds amount? That's a like-for-like comparison. How many pounds on this? How many pounds on that? What's the total interest I'm going to pay? Okay, and also the term. How long will it take me to pay this off? Okay, these are two things that you can compare really, really easily. So it's important to know to ask the right questions, not the wrong questions. Okay. So this is probably going to be quite a quick live today, because it's a very simple subject, but it's made complicated by people that want to charge you loads of money to explain it to you, so it seems complicated. So let me show you another way that the banks keep you in debt. And again, bear with me, because I'm going to show you a couple of ways that they do so you understand. But then what I'm also going to do is I'm going to show you just some things that you can do to change that and accelerate that. Okay. So one of the things that the banks do is they give you like a 25-year mortgage. Let's say you get a 25-year mortgage on a fixed rate, and you feel, you've got a great deal. I got a fixed rate of 1.5% or 2% or whatever it is, and I feel good about it. I'm excited. I got a deal, and there was a special offer, and it was special, and I felt special because I got that rate, etc. So now what happens is, 3 years later, that fixed rate comes to an end here. And what happens is they say, right, that fixed rate has come to an end now. So now you've got, your rate's going to go back up to the standard rate. Now, this hasn't been the case for the last few years because the rates have remained low. But as you know, they're just starting to creep up again now. So what you'll see more and more of this happening where, okay, well, the fixed rate has come to an end. The new rate is going to be higher. So the payment's going to be higher. But you know what? You can remortgage. And we'll come back to remortgaging in a minute, why they want you to remortgage. You see, the banks want you to remortgage because it's in their favor. But what they do is they say, right, the payment's going to be a little bit higher, but if you like, we could extend the term and that will make your payments lower. Okay? So, great. So now your 25-year loan just became a 28-year loan, and then they keep doing it, and then it becomes a 31-year loan and a 34 and then a 37. And pretty soon you've had a mortgage for 40 years and you still haven't paid your house off, right? So you can understand why it's called a death pledge, right? So the point is, that's one way they kind of get you to stay in this debt. All right. Is that making sense to everyone? So if that all makes sense to you, give me some love hearts, likes, high fives, thumbs ups, whatever it is you want to do. Just give me some feedback so I know that you're learning. Okay, awesome. So yeah, loads of love. I mean loads more love hearts than that if you want me to show you how to accelerate your mortgage, definitely. Okay, so it should be like love hearts all over the screen right now. All right. So we talked to ask the wrong question. So then you've got the other side of things where it's all about how loans are structured. And it's basically, it used to be a long time ago that, they just charge you whatever the rate was, that's what they charge you. And then they started applying interest, monthly or charging it monthly. And then they started charging it daily or applying it daily and then charging it monthly, which is how a lot of companies do, as I'd say most probably companies do it right now. They apply it daily and then they apply it daily and then they charge you. You pay it monthly. Okay, so what happens is this: in the early kind of days of first of all, so your mortgage kind of goes like this. You start out at 1 and then you go down, and it kind of does this. So let's say over 25 years. In those first kind of half of that loan period, if you like, what happens is it's all to do with how loans are structured. So a greater percentage of your loan is interest, okay? So that's why you notice when you get your mortgage statement after 1 year, it's like it's hardly gone down at all. It's like, well, hold on a minute. I've been paying, let's say my mortgage is $1,000 a year, a month. I paid $12,000, but it's only knocked off, like a small percentage of that. Well, that doesn't seem right. I've paid off $12,000. Well, that's because, let's say this is your payment, okay? What happens is, in the early kind of years, most of your payment is made up of interest. And only this small piece here is actually the capital. And what happens over time, so later on, kind of down here, you'll find that a larger proportion is capital and a smaller proportion is interest. And that's why what happens is it starts to accelerate. Okay? Is that making sense to everyone? Yeah, give me thumbs up and all that stuff if that's making sense. Okay. So it's designed to do that. Now, some of you might be thinking, well, hold on, Steve. When I remortgage up here, I didn't take an extra 3 years. I kept my term the same. So I'm not being affected by this. Well, no, you are. Okay, so first of all, the fact that they apply interest daily, which means every time you pay off an amount of money, every day they're adding more money. So it completely slows down your ability to pay off, okay? Now, this is the key. So this is what happens. I kind of feel like I should use a different color for this. Let me see how this red looks. It's not too bad. All right, you can still see that red? Yeah, cool. All right, so what happens is, let's say after 3 years, they say, okay, you're 3 years in, you want to remortgage. Now, they want you to remortgage. You might think, well, why does the bank want me to remortgage? Well, the reason is because it kind of resets the clock again. Because remember, in this third year, let's go back to blue. In this third year, the percentage of your interest payment is less, the capital is more than it was in the first year. All right. So when they remortgage, that starts a new loan again, which means that it extends the term. Yeah. So now the clock resets again. Now a higher percentage of your payment is now interest again. So you end up paying more. So what happens is you keep resetting the clock, and it just, I mean, even if the term remains the same, what happens is they make more money from you because a higher percentage of your interest, of your payment, is interest. Does that make sense to everyone? Yeah? You know, so Shayuni's got love hearts on there. Is that just love it because you work in a bank and you get to make loads of money, or love it because this is something you're loving and you're learning, right? I'm hoping it's the second one. All right. So, what do you do to solve that? Okay, so there's a few things you can do. Now, obviously, you're going to get the lowest possible or the best possible deal you can. So again, speak to a great broker to do that. Again, you've got to also be aware that, you know, some mortgage brokers are just there to sell you mortgages. They're just going to get you the one that pays them the most commission. So definitely kind of do your research, or go with somebody that you know that you can trust, maybe good recommendations or stuff. You know, we have when we look as a company, when we look for a partner that deals with mortgages, we look for companies that we know have got great reputations, because we certainly don't want to refer our clients to somebody that potentially jeopardizes, you know, our referrals, which we work on. So a couple of things you do. So one of the things you can do is you can just simply overpay. So if your mortgage is £1,000 per month, you can say, well, every month I'm going to overpay, you know, an amount of money, let's say £200 a month. So now your outgoings have gone up by £1,200, and the challenge there is maybe you can't do it every month. Maybe, you know, you've your Christmas coming up. So what you find with that is it can be kind of inconsistent. You know, you don't always do that. But if you do that and you overpay, and most more, again, I don't want to say most, but a lot of mortgages, check your own mortgage details on this. You know, they'll give you a percentage that you can overpay every year. And if you feel like you're really getting into overpaying, then definitely when you look at a mortgage, look at a mortgage that maybe doesn't have a limit to how much you can pay or any penalties or anything like that. So again, I'm not a mortgage advisor or broker. It's not my area. You know, I just understand financial concepts a little bit. So overpaying is a good way. So that's one way of doing it. Again, for many people, it's like, oh, that extra money, it's like having an extra bill every month, you know. But if you have disposable income, you want to do it that way, great, not a bad thing to do. But by doing it that way, you do also miss out on another kind of benefit. So another way to do that is using a concept called finding the 13th month. And so it kind of works like this. So let's say you've got a mortgage, and your mortgage payment, let's say it's £1,000 per month. Okay. Many people get paid monthly, many people get paid weekly, but let's say you took this £1,000 and you said, well, I'm going to take that 1,000, I'm going to divide it by the number of weeks in a month, and I'm going to make that, you know, 250 per week that I'm gonna pay. Now, for some people, you might say, well, hold on, I mean, that's just taking that payment, divide it by 4, pay 250 a week. Well, that seems like the same, right? That doesn't seem like I'm paying more money. Well, that's kind of the point. You're kind of tricking yourself into paying more every month without really feeling it. So what you do is, remember, there are 12 months in a year. So 12 months times £1,000 per month equals 12,000, right? I think I'm going to go off the page. Wouldn't it be a shame if the actual next bit sort of fell off the bottom of the page? Anyway, I'll try not to do that. So 12 months. Now, because there are not exactly 4 weeks in every month, okay, when you pay $250 per week, you pay 52 payments of 250, which actually works out at, £13,000 is what you'll pay. So you end up paying an extra month off of your mortgage every single year. Now you might say, Steve, well, that doesn't really sound like a lot, but actually on a kind of 25-year mortgage, just doing that one simple thing of paying weekly, or you can even do it every 2 weeks, but I'm a believer in the weekly way. You end up knocking usually between 3 and 5 years off of your mortgage payment date, depending on the interest rate and so on. So it's just a kind of good habit to get into. Now, there are a few things you've got to do. I mean, you've got to make sure that you don't miss a payment. You've got to make sure that it doesn't, you've got to look at what your payment date is, and then, don't kind of just say, well, I'm not going to pay my £1,000 now. I'm only going to pay £250, because then you're late with your £1,000 they're expecting. So again, you've got to look at when you do this, and certainly get some help on that if you need it. The other thing is, the reason why it saves you some more money as well is because, remember, because they, in many cases, apply the interest on a daily basis, but then take it monthly, what happens is if you're paying a bit off here, like $250 off here, what happens is there's a little bit less interest they can charge you. And again, it's only small, but over a long period of time, 25, 30 years, again, it makes a big impact. It's a small change that can make a big difference. I actually did this example one time for a client of mine, and I actually put it into some separate software to work it out. They had a 30-year mortgage, and it was their first, they'd just paid one payment, or they were about to pay one payment, and it went from being a 30-year mortgage, just paying weekly, took them down to, I think they kind of rounded it up by a few pounds to make it an easy payment, but it took them down to 21 years on a 30-year mortgage. Again, not telling you that's what's going to happen on yours, because it does depend on the rate you've got, and again, what you do in the meantime and so on. But if you apply these principles, then again, it can just have a really, really, really big impact. I think in that example also, it saved them something like £69,000 in interest. They're not going to pay, because they'll pay it off sooner. So that's really kind of what I wanted to share today. It's nothing wrong with having a mortgage. Some people talk to you about good debt and bad debt, and if you've got like a buy-to-let properties, then yeah, interest-only mortgage can be a good thing there. If you've got an interest-only mortgage on a personal property, yes, it can give you, a low payment right now in particular, but of course it's not designed to ever get paid off. So, eventually you want to either overpay that, and again, what you could do is start overpaying your interest-only mortgage. Again, check your terms of your mortgage, but start paying off some capital, so it's kind of like a repayment in a way. Or of course, look at remortgaging at some point and get a repayment mortgage, so you can start paying that loan off. When it's something like a buy-to-let property, if you're getting 3% and you're making 6% on the rental, then it's kind of good debt. It pays for itself, and it's just a facility you're using as a business. But certainly on your home, your family home, the one you live in, my feeling would typically be you want to pay that one off at some point. Leave it as an inheritance for your children and your children's children. Leave a legacy, and so on. So again, hopefully that was useful. I think this is a shorter live than mine as usual. As usual, feel free to post any comments, ask any questions, and of course I'll try and respond to as many of them as I possibly can. Feel free to have a look at my previous lives. Look me up on YouTube. Also, really appreciate if you would follow me on Facebook and put to set to see first, because again, I'm just kind of culled like 1,000 of my Facebook friends, because I ran out of people. So again, I know that I'll get filled up again pretty quickly. So if you could do that, that would be fantastic. So apart from that, thank you guys for joining me today. I will be doing another Facebook Live next week. I am actually off to Atlanta for a work thing, and it just happens that my flight falls dead on when I normally do my live. So what I'll try and do is schedule a live in around another time. so that I don't miss kind of my weekly lives. And by the way, guys, if you've got anything you'd like me to cover, my main areas, of course, are leadership, goal setting, goal achieving, sales, that kind of stuff, financial education stuff, effective communication, those kind of things. Again, more than happy to share those. Again, please post in the comments things that you think you'd like to hear, learn, and we'll go from there. Have an awesome week, guys. Take care. Bye.